I don't think that we're necessarily in for a broad-based correction, at least not one that's long-term. I mean, there will always be ebbs and flows. There will be bad months. We'll have bad quarters. But at the end of the day, I think the housing trend is clear and that trend is up.
The consensus is that the Fed may not be done raising rates just yet. What impact do higher rates have on the housing markets? We're here to talk about the residential and the commercial sides with our next guest, Briton Hill. He is a managing partner of the Providence Capital Group. He's an expert on real estate and lending. Welcome back to the show. Always good to see you, Briton.
David, thanks for having me back.
Well, it's been an interesting year for the real estate markets. First, people were initially surprised that we didn't have a big correction in spite of mortgage rates rising, in spite of the 10-year rising and the Fed funds rate rising. Were you surprised that higher interest rates didn't initially crash the housing markets overall?
Initially, I think that was what was at the forefront of everybody's mind was, let's keep an eye out for housing weakness. And we certainly saw a slowdown, but I wouldn't say it was a surprise. And simply because if you actually look back, David, at the last time interest rates were really skyrocketing during the 70s and 80s, housing actually rose pretty consistently all during that time. In fact, it was one of the highest performing asset class, or one of the highest performing asset classes during that time. It rose at an annualized rate of about 11% per year, all through the 70s and the 80s. And so I think we're just seeing a repeat of that pattern, and it's primarily driven by low inventory.
Okay, so it's more of a supply issue. So then once, I suppose, inventory clears up either through housing construction starts or people, I guess, wanting to move, would that be the catalyst then to a correction?
It's a good question, and it's always a fine balance. Right now, I think the primary driver of appreciation among housing is the low inventory. And I think that that's here for the foreseeable future. But you have to think, what would it take for, new housing starts to really start picking up and for new homes to start hitting the inventory market? And I think it's going to take rates either slowing the rate of increase, or it's going to take, ideally lowering of interest rates and the Fed cutting interest rates and mortgage rates falling. But if that happens, then you also have cheaper debt service on one hand, which obviously is a tailwind and furthers asset price appreciation. So I don't think that we're necessarily in for a broad-based correction, at least not one that's long-term. I mean, there will always be ebbs and flows. There will be bad months. We'll have bad quarters. But at the end of the day, I think the housing trend is clear, and that trend is up.
There's data coming out from the U.S. Census Bureau. So in terms of new residential construction, the permits have been sliding down ever since 2021, but the completions have been going the other way. It's been trending up, and the starts have been somewhere in the middle. Now, when you're looking around in the market, do you see a big divergence between the number of new permits being issued and actual houses being completed?
Yeah, I think what's happening there is you have these large contractors and developers that own a substantial amount of land already, and a lot of it's been subdivided and already permitted, and they're in the market. They still have access to capital, but as far as new permits goes, you don't have a lot of new entrants into the building market, and you also don't have a lot of big developers that are actively searching to go and acquire new plots of land. And so I think that's what is really kind of pushing the low amount of new permits. But as far as completions go, to your point, David, there's still building happening. People are still buying homes, and at the end of the day, it's still a positive returning housing market.
So when you're looking at this data, then can you make the assessment that completions going up is not necessarily indicative of a pickup in new housing? Because it could be, like you said, it could be old permits that are taking a while to be completed.
Yeah, you have a combination of things. For starters, we still do have some supply constraints. I mean, albeit not nearly as bad as what we saw in 2021 and 22, but it still is taking longer to get things done than it has historically, and especially where you have a lot of nervous home buyers and a lot of people just dropping out of the race altogether. And so it is harder to line up potential buyers with potential sellers in this market because there's not as many people out there. But exactly, I mean, homes are being completed, and I think a lot of it is just existing inventory and existing projects that are either just getting pushed across the finish line, or it's taken builders a lot longer to actually find capital in most cases in this environment. It's very difficult to get money from a bank.
So let's talk about that. Let's talk about your area lending and just what you've observed. So first of all, before we talk about the banks, the people that you've been working with, your partners, what are they looking for capital for? In other words, what types of projects are most on their radar right now?
Geez, I mean, it's anything in this environment. Banks are really difficult to work with, and it's because their balance sheets are just off. Like, we'll get into that more in a minute, but the bottom line is capital needs are still there, whether there's cash in the market or not. So we've been doing a lot of construction loans, a lot of rehabilitation, a lot of just new builds and things like that. But I would say the biggest thing that we're doing now is construction loans and refinancing out other debt that's coming due. And the current lender is just not in a position where they can actually renew the debt.
Can you explain why that is? Why is it that they're not in a position to renew the debt, and why the balance sheets of the banks are in trouble?
Yeah, absolutely. A lot of it just has to do with, the interest rate cycle we're in. But when you realize that a lot of the banks did an extraordinary amount of lending at super high leverage in 2021, and we've slightly fallen off those levels. We certainly don't have interest rates that are as low, and there's some concern about marking asset values to the book value of what they're actually worth today. It's put banks in a really precarious situation where they rely on ratios to do their lending and in order to extend credit. And if you have a bank whose ratios are off and they're not able, or they're skirting right on that line, the last thing they want to do is create a type of situation that makes creditors nervous and obviously depositors nervous, so that they have a run on the bank. I mean, we don't want to see another Silicon Valley Bank. We don't want to see another First Republic Bank type of scenario. But that's what a lot of these banks are worried about. They're riding this very fine line, and the way that they're managing it is by not extending credit and not overextending their balance sheet. So they're kind of stuck. They're waiting for assets to really start appreciating again, or they're waiting to divest certain loans so they have liquidity. And the bottom line is they're just not in a position where they can extend a lot of credit right now. And so it's putting builders especially, but really anybody who's looking for capital from a bank, it's putting them into a really hard spot where banks are hard to work with. The time it takes to get a loan is extraordinarily long compared to what it used to be. And it's just it's no sure thing of whether the bank is actually going to deliver at the end of the day.
Yeah, you're right. Banks do have to adhere to a capital reserve ratio. Do you think this ratio has been compressed recently because banks are competing with money market funds because interest rates have been higher? People are putting their funds in money markets. There's a huge surge in the nominal value of money markets funds nationwide, and I just wonder if that's taking money out of money that could have gone into bank deposits. Are you seeing that?
Absolutely. As a private lender ourselves, we're seeing everything, especially when it's coming to banks and people who are fleeing banks. The biggest thing that we're seeing now, and it's kind of interesting to watch pan out, is banks are being eaten alive by their largest investors and their largest depositors. So, especially the ultra high net worth crowds that have 10 million plus with banks, those are the people that when they went to the bank for loans when money was 2% or, just dirt cheap, the bank was looking at 10 million in deposits and saying, yeah, this is a good depositor. They have sufficient net worth. They have good assets. We're going to give them a huge loan. So they levered to the hilt and they extended a lot of credit to these big depositors. And now these same depositors still have a lot of money and a lot of cash, 5.8 trillion in money markets right now. And they're kind of looking at what they're getting in the bank. They're seeing they're not really earning any interest. And then on the flip side, as far as lending goes, they don't want to borrow money now at 7, 8, 9% for certain loans. And so what they're doing is they're actually pulling money out of the bank, which is further worsening the problem that a lot of these banks have. And instead, they're putting them into money market funds. So you're seeing brokerage accounts swell right now, especially with cash. Seeing a lot of people going into short-term T-bills, and that's all at the expense of these big banks who they've loaned money to these people with tens of millions of dollars who historically kept tens of millions of dollars at the bank. And now they're just sucking it all out and putting it into money markets. And so it's a difficult place to be right now for bank lenders.
Okay. Now, in terms of activity for transactions on the consumer side, the 30-year fixed mortgage rate peaked around late August at 7.23%. It's been kind of trickling down. Now it's at 7.12%. I wouldn't say it's been a huge correction, but it's been kind of coming down. Now, have you noticed a pickup in transaction activity, either from selling or buying, as a result of rates pulling back slightly?
Um, Nothing noteworthy, but what we have seen is a massive uptick in loan requests that we've received. Normally, we're sitting between 10 and 20 million of active loan requests a week. The past 3 weeks, though, we've been sitting at 200 million or closer to 200 million, between 160 million and 200 million. And those numbers are extraordinary. I mean, it was almost a 10x at a moment's notice. I don't know what triggered it over the last month, but something extraordinary has happened where, either word has gotten out that private lenders are starting to take market share and can still get deals done. And, we're well capitalized by private investors who are hungry for yield, or it's just banks are pushing people away in droves right now, but there's still, major need for capital in this illiquid market. So not necessarily so much on the buying and selling side that's affected what we're doing, but certainly on the need for capital side, we've seen a massive uptick.
Loan requests for residential housing or commercial?
Yes, this is all residential. We're a residential lender, and we focus on, multifamily, new builds, things like that. So certainly the residential sector needs capital.
Okay, and this is mostly in Utah that we're talking about?
Utah and the Mountain West. We do have some projects in the Midwest, but there's enough here locally, just in the Mountain West region, Utah, Idaho, Wyoming, that we can fund most of what we need to very close to home, where it's easy to keep an eye on.
Do you have any data as to what types of homes people are looking for most? Is it single family homes? Is it condos? Is it townhouses? Multifamily? What are the people looking at?
Uh, it's spread pretty far throughout. We're getting ready to do a townhome project. We're finishing our last underwriting. It's 240 townhomes in the Idaho area. But another really interesting part of the world that we're financing a lot in is Park City area, which is very high end luxury homes. You're talking $2 to $5 million builds, and that market is actually doing extraordinarily well. It's kind of the rich are staying rich, and the rich keep getting richer no matter what's going on in the market. That market is actually up quite a bit this year. I was hearing last double digit year to date already for that area, and so we're doing a lot of successful funding in that area. And then, we're doing a lot of kind of the lower end townhomes, Section 8 type of properties, mobile home parks. So we're low end and we're high end. And those are the two regions that are doing really well. The high end people have cash still to buy. And then the low end builders, the low end home buyers, I guess it would be, they're receiving more government subsidies via Section 8 or grant pools. There's more resources available to them, similar to what you saw in the 70s and 80s, where in order to offset rising interest rates and mortgage costs, people either paid cash, or if you couldn't afford to pay cash, there was a lot of government subsidies, tax breaks, and things like that kind of came into effect to keep the housing market propped up and to keep it affordable for a lot of people.
One thing that I've noticed, well, not that I've noticed, but the data has noticed, is that real wages have been climbing. So if you look at the St. Louis Fed data, real wages, the median household real wage has been climbing ever since the beginning of the year. Real wage, I'm talking about the nominal wage adjusted for inflation. Do you think then that people will, use this, I guess, higher earnings as leverage for new for more expensive homes, or do you think this will have no impact on the housing market just yet?
Um, I think one of the, obviously one of the fundamental drivers of the economy is what people's wages are in real terms. And to your point, I was actually just looking at this today, interestingly, and it's only by like 0.1%. It's tiny, but for the first time in over 2.5 years, wage growth is now outpacing inflation. And so that's a big thing I know that the Fed is pushing for. And that's kind of why we're seeing such high interest rates. We had to tame the inflation and get it to a point where everyday people can afford it. And if your wage growth is ahead of inflation, generally speaking, you're on your way to a healthier economy and certainly a healthier consumer, a much healthier consumer. And so I think that if we keep trending in this direction, I wouldn't say we're out of the woods yet, because it's such a marginal spread between what real wages are and what the inflation rate is. But if we keep trending in this direction, it's going to put more money in people's pockets. People are going to feel a little bit more secure. They're not going to feel the penny pinching at places like the grocery store or the fuel pump as much. And in the end, it's going to drive more money into things like housing purchases and improving standard of living.
What I don't understand is why there's such little inventory. Going back to the inventory problem we addressed early in the interview. Now, if people are buying a home for their primary residence, I understand. But if for investors who are buying perhaps a second or third home as an investment, now if you bought pre-pandemic, chances are, depending on the area, of course, but chances are you're probably up, right? So unless you think that prices will go up even more in the next year or two, I don't know why people aren't taking profits now, even on their investment properties.
Well, if it's an investment property, you have to consider the tax ramifications. I mean, if market conditions are stable and the investors don't necessarily need cash out of the deal, it makes sense to hold, or else you're going to have to 1031 exchange for US investors. You have to do a 1031 or else pay tax. And a lot of the time you're going to 1031 and have to take on debt at 7 to 9% interest, where a lot of the time it's just safer to hold. And that's really the driver behind everything, is these high interest rates. You have a lot of people who, to your point, pre-pandemic locked in a 3-4% mortgage, or even as low as a 2-something% mortgage, that now they're looking at it. Market values haven't fallen. I mean, the average, I think, numbers came out this month, housing rose on average 4.4% year over year. And so it's not like they're getting anything cheaper, but on the flip side, the cost of capital is double or triple. And, you're talking a double or triple over the monthly payment simply to do one flop to another. And so that's why you're not seeing a lot of people selling their homes, and it's contributing to a much lower inventory. People aren't buying, selling, trading at all. And it's really driven by the interest rates. And so it's created an inventory squeeze.
Well, so here's maybe my logic and maybe evaluate this. So I'm putting myself in the position where the shoes of somebody who may have a property as an investment vehicle. And I'm thinking, well, my cap rate's gone down because, like you said, mortgage rates have maybe risen. If I'm on a variable, if I'm on a fixed, then maybe not so much. But in any case, interest rates are going up. Maybe the rent I'm charging my tenant isn't going up at the same pace. So yeah, my cap rate's going down. Why don't I just sell my property at a gain, put that money somewhere like a money market fund, where we're in a CD paying a higher interest rate than actually inflation, and I'm beating inflation with just cash, basically, right? I don't have to deal with rental yields and all that stuff. You just park my rental money in a in a risk-free deposit. What do you think?
Hey, yeah, it's a good idea. I mean, if at the end of the day it pencils for you and you're not going to have an extraordinary capital gain and you want headache-free, risk-free money, I mean, you can't go wrong with 30-day T-bills right now. They're yielding almost 6%. But the other thing, David, I think people are just finally realizing that, whoa, we have rates. I mean, for decades, rates have been paltry. It was just almost not worth it, especially, short-term rates were below long-term rates. And now, for the first time in who knows how many years, we actually have decently yielding interest rates, especially on the short-term side. And I think that we're seeing people are really slow to respond, but they're starting to notice. And that's one of the reasons why we're seeing these money market funds just swell to extraordinary assets under management, is because people are taking money off the table. If they have an investment vest, or they, to your point, they liquidate a project or something like that, rather than going back out in the market, they're paying their taxes and they're just parking it in short-term money market funds and taking their 4 to 5%. So that is what a lot of people are doing. And that's why we're seeing record amounts and, more and more each day enter the money market space.
I'm looking at, so if you Google will rent and then Google autocompletes go up in 2024, people are really concerned about where their rents are going to go. So I'm seeing a lot of different data here. So according to Zillow, I'm reading this Yahoo article, Zillow's forecast of U.S. home prices was revised upward this month, with the typical home value predicted to rise 6.5% from July 2023 through July 2024. So a lot of the forces that we talked about. Meanwhile, I'm reading the Washington Post. It says their headline, "Rent is finally cooling." Different areas have different, obviously, price changes. So let me just ask you: what does your analysis tell you? Are we going to see major price changes in rent in the large metropolitan areas, at least?
Yeah, everybody loves to use the term cooling, and that's very relative. I mean, when you're talking double-digit rent growth all during 2020 and 2021 and 2022, 5% rent growth sounds pretty reasonable, and that's definitely cooling. And when I hear the term cooling, I don't necessarily think falling. I think that the rate of increase is just going to be dramatically slower from what we've gotten used to over the past 2 years, especially in major cities like New York, Miami. I know that those markets are still doing well. You're generally seeing asset price increases across the board, especially with real estate. But I don't think double digit growth is going to continue. So I think renters can at least look forward to that. Your rent increases aren't going to be massive year over year. I mean, real estate's still appreciating, at least residential real estate is. So at the end of the day, that's a driver of higher rent prices as prices go up and just the cost of housing increases, but it's not going to be what it once was.
Well, if we have a recession, have you noticed any correlation between rent prices and prior recessions? Um, have you looked into this?
Rent is typically resilient, and part of my thinking behind that is recessions are generally short term, and when you're signing a lease, you're signing a 12-month lease, so people are locked in at the pricing that they have, and there's not a lot of variable changes in that time. And we've had a we've had a good go of short-term recessions where they weren't long enough for people to really have to start adjusting the rent prices. So it would kind of remain to be seen. Do we have a short-term recession, kind of like we did last year? It was just a blip and nobody even realized it happened. Or do we have something more long-term that lasts a few years where people are really starting to hurt and we really can't afford rents, and more rent-controlled cities start implementing policies? And I think that it's really going to depend on how long of a recession we have.
Well, if you were a landlord, what are the major factors you would be looking into in order for you to, I guess, raise, if that's possible in your area, if it's not rent controlled, or even lower your rent, depending on the market circumstances?
Sure. I mean, inventory is a huge driver of everything. If you're in an area that's oversaturated with inventory, that's reasonable. I guess that's a good reason to start considering lowering interest rates, especially if you're having a hard time attracting renters. But on the flip side, if you're in an area that's still high in demand, certain areas like Miami is always a good example I come down to. They've had double digit price growth over the last year, but there's still a lot of demand there. You don't necessarily need to be making massive price cuts. It's really just dependent on inventory. But for a landlord that wants to increase rents, I would look for sectors and areas that have high demand, or maybe even consider going the low income route, because there are more low income applicants now than these municipalities can possibly handle. On our mobile home park loan investments, we know that the municipalities of the places we're based in have hundreds and hundreds of applicants, so many that they've had to just stop accepting applications entirely. And if you can make the numbers work, that's free money. The government's going to pay a substantial amount of that rent. It's you're getting a good portion of your check from the government, and it's a pool of endless renters where if you contact the local housing authorities and say, hey, we want to get set up with you guys, we want to work with you, give us the punch list, and you're willing to follow those terms, you'll have an endless stream of renters. That's a great sector to be in.
So, if I'm a potential investor and I'm looking at the residential real estate sector, potentially to get rental yield, and I'm looking at data in the U.S., the price to rent ratio has skyrocketed in the last, I would say, 12 years. It troughed around 2012 at around 90, and now it peaked around more than 140, and now it's slightly down. So the point is, it's gone up a lot. Now, from an investment standpoint, this doesn't look like an attractive value proposition, because I'm paying, because the price of my home, if I'm buying something into it now, has gone up dramatically more than the price I could charge for rent. Do you think that because of valuations alone, real estate has kind of lost its luster?
At the end of the day, everybody needs a home, and there's going to be certain sectors where, yeah, absolutely, it's lost its luster. But I think residential is just one of those areas that's always going to be resilient. I mean, if you look at the housing affordability scales, housing was far more unaffordable in the 80s, just with how high interest rates were, especially the early 80s and late 70s, early 80s, with where interest rates were, than it is now, just on the housing affordability scales. Granted, prices are a lot higher now, but higher interest rates certainly contribute to that. But we saw still resilient house price increases. As far as rents go, it's challenging. It's really going to depend on the areas you're in, because there's still areas with a lot of demand and there's still people that can afford to pay higher prices. It it's not fun. I mean, I don't want to have to pay higher prices, but there's areas where people can afford to pay it, and there's still really low inventory, and that's driving a lot, both on the apartment side and on the single family purchasing side. But it really depends on what area you're in. I mean, you can take the average, and if you've got 1 foot in boiling hot water and 1 foot in freezing cold water, on average, you're feeling great. You should feel great. But on the left side, you're scalding to death. On the right side, you're freezing to death. So you have these polar ends where it's far too expensive, and we're going to see contraction start to happen. And then on the other side, things are still really cheap and really cool, and there's room to grow.
Okay. So, bottom line, let's get your forecast then. Where do you see mortgage rates headed from here, up or down?
I don't think we're through the cycle yet. Inflation is still high. I think that the rate of increase again is going to slow, but I could see 9% mortgage rates. I don't think that's out of the mix. I mean, we're only a point and a half from there, so I could see mortgage rates hit 9%, and short term rates hit 7.
Do you think an increase in those rates and perhaps even the Fed funds rate will have any significant impact on the price from here?
That's the $1 million question. If you have 1,000 people that can afford a 5% mortgage, and 800 people that can afford a 6, and 600 people that can afford a 7, and 400 people that can afford a 9% rate, it's irrelevant when there's only 50 homes to buy. So it remains to be seen. When do we hit that tipping point where the amount of people that have money that are looking for homes is offset by, I'm priced out of the market, I can't afford a 10% mortgage. And so far, we're not there yet, but I think when we get there, what we've learned is the Fed is quick to react. And the nice thing that we have now, which we haven't had for years, is the Fed has some ammo. I mean, we have 5.5% short-term rates. If we start reaching contraction territory and house prices start falling and markets start falling, the Fed has more ammo than they've had in years to actually start cutting rates and to, I guess, combat a deflationary environment. But for right now, inflation is ruling the day. We still have inflationary pressures. And that leads me to believe that we're still going to see rate increases until those inflationary pressures abate.
I'm seeing headlines like this. American cities are trying to convert office space into residential units. New York is working on this. This is obviously a longer term development. These conversions won't happen overnight, but I'm just starting to see a rotation in priorities. Are people giving up a commercial space and prioritizing residential as an investment now?
Yeah, I think the pandemic was the nail in the coffin for commercial space, especially big office buildings. We learned that people can work remotely and can perform pretty well working remotely. I think a lot of people prefer to work remotely, and there's been a lot of backlash to businesses trying to call them back to the office. And at the end of the day, we're in a business cycle where every penny counts. And so when you have empty corporate office space, a lot of the office buildings I go to nowadays are just it's a ghost town. It's a shell of a company that's operating there. It's it's just dead space to establish a presence. And so you're seeing a lot of cutting costs happening, and that's kind of contributing to, well, great, we have a 55-story tall commercial space. What do we do with it? And these landlords, they're still capitalized. They have cash. The smartest thing to do is, well, there's still demand in the residential space. Let's just convert it to apartments. And so they're shifting out of an asset class that's struggling into one that's still performing well. And they're doing it out of necessity and just to streamline their balance sheet and to be efficient.
Is that a deal you would make? Let's say you buy a warehouse or you buy some sort of commercial space that's empty, and you can't find a tenant, and then you go to some developer and say, "Hey, let's just build some condos here." Would you do that?
Oh, absolutely. I mean, Utah based here. So downtown Salt Lake City, you see some of that, old warehouse space. They're being turned into some really actually pretty cool apartments. And there's some up in Logan, Utah, where they took like an old either electrical facility or some sort of mill, and they turned it into these beautiful loft apartments. And so I think there's a lot of really cool things that can be done in that space, especially if you have some of that kind of old vintage flair. It makes for a great living spot, and people seem to love it.
There's actual ROI on these investments.
Yeah, absolutely.
Okay. Would this probably put some downward pressure on supply if there's more supply coming online? Perhaps that could equalize prices. I'm just speculating.
Absolutely. Yeah. I mean, if you can add more to the supply pool, absolutely. And I think that's what we're seeing. That's why a lot of these conversions are happening is there's a supply shortage and they're just capitalizing on the lack of supply by adding more to the market. And it's performing well.
And we spoke about this kind of last time, but let's revisit this topic again. For investors watching who may want to purchase real estate as an investment, do you have any preference for areas, states, cities, jurisdictions? Perhaps if you looked at data for migration or just what's hot these days?
Tax advantaged and affordable are the two best things you can do. And so you have it real estate's really hard because it's so geographical. And you could say Texas, and some areas in Texas are doing phenomenally well and others are really struggling. It's difficult. But generally speaking, if you pick a state that is tax advantaged, pro business, and affordable, some even in somewhere in the mid range, you'll do well. So we like areas in the Midwest, not only because they're affordable, you typically have lower and more, I guess, friendly state income tax states in there. But also from a low income housing perspective, there's good opportunity to enter the low income housing space. So Midwest, the South, and those are areas that you're seeing do well. They're performing well. And it's because a lot of money's fleeing and migrating there. You have a lot of money leaving high cost of living states, New York, California, and they're going into the Mountain West, the Midwest, the Southeast. And so those are areas that I really like. Now, subregions within those areas changes sometimes day to day, especially with so much corporate shifting happening right now, moving headquarters and downsizing it. You can have a small town that's so dependent on one company all of a sudden just get wiped out because the big anchor business that's employing a good portion of the town has left. And so it take it day by day on those areas. But my biggest thing is, again, to just get down to the fundamentals, is favorable tax structure and relatively affordable, especially compared to high cost of living areas.
I've been getting asked this question a lot by my peers and my friends who are looking to buy a home. Millennials, younger people, they're really struggling, especially in Canada, where I live in Vancouver, where valuations are super high. And it always comes back to me, like, I wonder, is it still the American dream to own a home? Is that I want to get your take on this, because if I'm buying a home right now, first of all, I need at least 5% down payment, probably more realistically if you're going to qualify. So that's a lot of money up front that I could be investing in other things that could generate a yield. And then because mortgage rates are high and because valuations are high, my monthly payments are probably going to be a lot higher than if I'm renting. And at the end of the day, if I'm buying in an expensive area already like Toronto or Vancouver or New York, San Francisco, how much capital appreciation will I actually realize? So I'll just pose this question to you. What are the financial benefits of owning a home versus just renting?
Yeah, I mean, I'd say some of the financial benefits, if you're like me and you believe that this housing cycle will be similar to past ones we've seen, and that asset appreciation is still going to happen in real estate, especially residential, I think that you can buy a home comfortably right now, not necessarily financially comfortably, but you can buy it with peace of mind knowing that I'm not going to lose everything here. And the central banks are going to defend that dream. I still think housing is the American dream, and it's because a lot of Americans have the bulk of their net worth, and even Canadians, a lot of people have the bulk of their net worth tied up in their primary residence. And so when you factor that in and realize that the Fed is going to try to protect that, I think you're going to start to see, subsidies and more things like that start to happen. But we also have interest rates where if you buy a home now, you're paying a high interest rate. It's going to appreciate. And if rates come down, you refinance. If not, rates are going to go up. And it's, well, gee, it's a good thing I locked in now. I mean, I bought my home at a 5.25% interest rate. At the time, I was ticked because a year prior they were at 2.5. And now I'm paying 5.5. My payment doubled over the course of a year. But now I'm looking at it and I'm like, gee, I'm glad I'm not that guy that's paying 7.5. And if rates come down to 5 or 4, great, I'll refinance. And that's awesome. I'm glad I have my home. And this is from a millennial who just bought a home last year. But if rates keep going up, it's like, well, at least I have my home. So if you're on the fence and you're wondering, should I buy a house now or should I wait? I say just bite the bullet and buy a house. It's better than paying rent with the uncertainty of how much is my payment going to go up next year. At least you're locking yourself in. Your rate might be high. It's certainly higher than, what we would have paid 2 years ago. But the bottom line is you can refinance if rates go down. And if not, at least you're locked in now before they go higher.
Would you get locked in rates right now, or would you get a variable if you were to buy today?
I would. I'm a fan of locking a rate in because so many people get into trouble with variable interest rates. That's what happened in '08, and it's it's a way of deferring now to punish yourself later, in my eyes, because it's like, yeah, if you can perform, in the next 3 to 5 years while your rate is low, great. But a lot of the times people struggle to, and if you don't perform, then your rate's going to get jacked up way higher than you would ever imagine it and feel comfortable paying. So if you can afford a fixed rate now, I'm always a fan of fixed rate. It saves you from a potential pitfall in the future. Personally, I have a fixed rate.
The downside is if you have a fixed rate and rates go down, you're losing. Well, you're not losing money, but you're losing the opportunity cost of potentially getting a lower rate, right? That doesn't bother you.
No, that doesn't bother me as much as potentially the unknown of, we're in a higher interest rate environment. What if there's a recession? What if there's a million what ifs? And I like to cut the potential what ifs as much as possible, just from a risk management standpoint. Lock in the rate, pay it, be comfortable with it. And then if rates do go down, well, refinance. Just go in and refinance. It's not automatically going to adjust down, but at least you're not adjusting upwards, which is the kiss of death for a lot of people.
It's a good point. We talked about your fund a little bit. Give us a 1 minute pitch of exactly what you do. We know you're in the lending business. How does it work?
Yeah, absolutely. We're a short-term private lender, and simply put, we went over banks. Banks are struggling to extend credit right now, but there's a lot of people with trillions of dollars on the sidelines who are interested in yield and are willing to provide much needed capital to developers. And so we're a short-term bridge lender. We provide 6 to 12 month loans. We're charging anywhere from 12 to 24% interest, and our investor returns have been, somewhere around 12 to 14%. And we're doing it at a loaning 50 to 60 cents on the dollar in most cases. So if a project's worth $1 million, we're only loaning 50 to 60, 500 to $600,000, what we would do in that case, 50 to 60 cents on the dollar. So we have considerable downside protection. It's short term. We get to adjust our interest rates upward, and it's an environment that a lot of these multi-billion-dollar funds are starting to pivot into. We're fortunate we were early, and so we've done very well over the past year and a half. But we're starting to see it start to draw some attention, especially from big hedge funds who see that there's yield and there's a vacuum created by banks not lending, and there's people that are willing to pay a lot of money for capital. So private lending.
Well, I'm noticing that credit card delinquencies are rising now. I'm not saying they're the same demographic of people, defaulting on the credit card debt, but are you not concerned about your lenders defaulting in this high interest rate environment?
That'd be great if they did. I mean, I've only loaned 50 cents on the dollar at a 6 month term. That means annualized, the real estate market would have to go to zero for me to lose money. I don't see the residential market falling 50% or more in a 6 month span. And if it did, holy cow, your new ammunition is, or your new currency is ammunition in that world. So it would honestly be probably more profitable if we had borrowers walk away, because the upside, if I take over $1 million project and I'm only net 500 grand in it, I would love to take it over.
All right. Well, where can we learn more about your fund and access information here?
Yeah, absolutely. Open to accredited investors, providencecapitalgroup.com. You can go there, read about some of what we do, learn more. And then there's a contact form you can fill out if you want to get in touch with me or just have some information sent to you. Absolutely would love to chat.
Excellent. Well, best of luck for the remainder of the summer. We've got a couple weeks left. Enjoy the sun, and we'll speak again next time.
Yep. Thanks, David. Have a good one.
Thank you, and don't forget to subscribe and like this video.